There she is.
Hi.
Aren't you right on time, huh?
Absolutely.
Okay. All right, I have some stuff set up here. We'll wait a few more minutes, okay?
Okay.
See who else might be here. There's usually, yeah, Joanna. Okay, she's here occasionally. I think we'll get, a couple this time. Hi, Joanna. Hiya. Can you hear me, Joanna?
Hello.
Can you hear me?
Yeah, now I can hear you.
There we go. Okay. You ready? You got your test today, huh?
What?
Test is due today, right?
Yeah, I actually did it yesterday.
Oh, you took the test already?
Yeah,
How did you do?
I did good.
Oh, wow, great.
Yeah.
Great, great. Yeah, this is kind of a test review what we're doing here, but
Yeah, but it's good to learn more.
yeah, we can pick your brain a little bit.
Yeah.
Hi, Giovanni.
Hey, Bob.
How you doing? No face today, Giovanni? You're the guy who can't put your face up, right?
Yeah.
You're using a computer from the 1940s, apparently. Okay.
Yeah. I connect to the Wi-Fi, but I can't use the camera quite yet.
Yeah, how do I know it's Giovanni if I can't see him? But then again, I wouldn't know him anyway. Okay, we'll give it a couple more minutes, and then we'll get going. What I've got, I'll go over the PowerPoints, not in great detail, but just to highlight things. And then I've got some Excel spreadsheets where I can give you some ideas, and we go from there. While we're waiting, and that's just gonna be a few more moments. Has anybody looked at the FSA yet? The FSA assignment that's due shortly?
Yeah, I've been looking a little bit on it.
Okay.
Yeah, but I think it's confusing. Yeah.
I'll talk about that as well. Yeah.
Okay, good.
Okay. Hi, George. Good to see you. Hello, Dave. Hi, David. How you doing? You must unmute.
Hey, I'm doing good.
Good. My favorite slot receiver, huh?
Sir.
Okay. I guess what we'll do here is we'll start off as we'll make this a test review class, okay? And I suppose we should start with chapter 6. And I'm going to run through the PowerPoint a little bit and then go to some other sheets I've prepared. Please, please ask questions if there's something that you still haven't figured out, something that's still giving you a hard time, let me know, okay? So let's see what we got going here. Let me bring up my spreadsheet here. Hold on. That goes there. That goes there. Share screen. Share. Oh, wow. Everything's there. Okay. I trust you can see the PowerPoint now?
Yep.
Okay. Okay. All right. This chapter 6, there's 3 or 4 overriding issues that we want to discuss, I think. Okay. The first one is the contra sales accounts. Are we comfortable with those? Do we have very clearly in our mind that gross sales, which is a revenue account, minus these 3 contra revenues gives you what's called net sales? Nobody should have a problem with that. You understand you never debit sales, never. You never debit sales. I can't say that enough. If somebody returns something, you debit these contra revenue accounts. You debit sales, returns, and allowances, okay? And you credit accounts receivable. If someone takes advantage of our 2% 10 discount, they don't have to pay the $100. They're only going to pay us $98. So our cash will be $98. We're not going to debit sales. We're going to debit sales discounts and relieve the $100 AR and credit card fees. When I buy my daily jug of soda at 7-Eleven for $3, 7-Eleven doesn't get $3. They get $2.90 maybe, because the credit card company takes out a bit out of the pool. Okay, so gross to net, and on the test, you might be given a problem where they give you the gross sales and they give you the net sales and they give you the credit card fees and the discounts, and you're gonna have to squeeze this. My point being, gross sales minus these three guys equals net sales. Hopefully you can navigate that, okay? Credit card sales, you hope they ask these kinds of questions, huh? Why do companies work with credit cards even though it costs them money? Well, obviously, they can appeal to more customers, no bad checks, you get paid right away. And the company has to pay. Contra revenue account, how about that? Does anybody have any problem at all with the 2% 10 net 30, huh? 2% 10 net 30, 210 net 30. You get a 2% discount if you pay within 10 days. Otherwise, you pay the net, the full amount, okay? And I'm just going to keep going and assuming that you're following and, await some questions, okay? This is a good one, and I bet there'll be something like this on the test, where they're going to ask you about a 2% 10 discount, which is actually a great discount, a great discount. And George was on top of this the last time we spoke. He can't, he remembered this pretty clearly. If you are giving up the money for 20 days to earn $2, that's 2.4%, but that's only for 20 days. You divide those 20 days into a year and you get about 18 times 2. That's a 37% a year. So there might be a multiple choice question on the test where they give you maybe 3% 10 and they'll give you 4 choices. I'm not saying you need to remember the formula, but just know that if 2% 10 is 37, 3% 10 is going to be better than that. And you might be able to work your way into a question there. Sales, returns, and allowances, huh? Net sales, here's your formula. Here's the formula. They might give you that, and ask you for the sales discounts. Being able to navigate. Hi, Kate. Going through our review. Okay, so that's the first area. Know your gross sales to net sales. Know that you use those contra revenue accounts to debit sales, since you never debit sales. Never, never, never. Trade receivables are the same as accounts receivable. That's come up I get a couple text people asking me that. Trade receivables means accounts receivable, means customers. Any other kind of receivable is a note or what's called a non-trade. Where I used to work, we loaned money to employees a bit, huh? Okay, now here's a big part of this. This is the second of what I'm calling 3 sections of this chapter. Bad debts expense. Bad debts expense. I'm going to bounce over to my other sheet here in a moment, okay? We have to estimate bad debts expense at the end of the month. We have to write a 2-line journal entry where we are going to debit bad debt expense and credit a contra receivable account called allowance for bad debts. Just like all other contras, it's married to something, it's married to the AR. So here they're giving you the number, and look at that journal entry. That is one of only 2-line journal entries involved in the world of bad debts expense. You write this entry at the end of the month, one time only, and then you're done with bad debt expense. What you're going to do with that allowance account is work it off against AR when you know who the bum is that's not going to pay you, okay? The allowance for doubtful accounts is a contra receivable, and this is what it's going to look like on your balance sheet. You're going to see AR, less allowance for doubtful accounts, net receivables, net realizable. This is what they expect to collect, okay? This is how much they billed out. And companies actually want a little bit of bad debt expense. If you're not getting any bad debt expense, that might mean you're not aggressive enough in taking chances with customers who don't have the best credit rating. And I could talk about that forever. Now we have a write-off. A write-off is the process of removing somebody from the aging. We found out that one of our customers, Decker, found out that this particular customer or customers is not going to pay them $6,969,000. They have been trying to collect this for 2 months. The fund's been disconnected. They saw in the news that the company went bankrupt. They have no assets. Based on that, they have a good faith reason to write this off. And they have to write it off. They can't pretend it's still collectible to avoid this expense. In other words, if Decker's short-term estimate this year was for a $10 million profit, this is going to knock that down to about $3 million. They can't delay doing this. Must be done. And again, this is the second of just two-line journal entries. Okay? Bad debt expense, you debit, credit the allowance, and then you use that allowance to reduce accounts receivable. That's the only thing you're allowed to do with it. Now here, I'll take us through this, and then I'm going to go over to the spreadsheet for a moment. Assume that they have a balance of accounts receivable of this, and this is the allowance balance at the end of the month. Let's look at what happens when we write this off. Notice it had no impact on anything. Take a look at that, huh? Accounts receivable before we wrote this off was 62. Now it's been reduced to 55,671. But the allowance account was also reduced with a debit. My point is the net receivables stay the same with a write-off. You have already recorded the expense against these write-offs when you did it in the prior month, okay? Two methods. One is pretty easy. One is a little trickier. I'll take us through that here. The sales method. All you do here is take the credit sales, multiply by the percentage, and that gives you the bad debt expense. It's that easy. Sales times your percentage, whatever the company uses. So that's going to become your debit. Here we go, 600,000. 1% of that is 6,000, right? Look at your journal entry. Not too tough. Sales method's easy. Sales times the percentage equals bad debt expense. And you know you only get a debit bad debt expense and only do it one time and credit the allowance. Aging method, or the accounts receivable. I just realized Barney's in my background. Anyway, the aging of accounts receivable, okay? This method here is a little trickier. Here, we're reinventing the wheel every month. We're going to go through the entire aging, column by column by column, and multiply out our various percentages, and we're going to come up with a number. But the number we compute is not the bad debts expense, and that's what makes this a little trickier. When you're using the aging method, you're not coming up with the bad debt expense. You're coming up with the balance you want in the allowance account at the end of the month. So you're going to have to take the beginning balance, subtract any write-offs, and then subtract this number and back into or squeeze into the bad debts expense. And here they're showing you we have a $50 credit balance to begin with. The balance was $50 to begin with. We want to end up with $1,201. There's your bad debts expense. There's your bad debts expense. Look at this aging of AR here. This is your T account, the allowance, okay? I can't estimate it enough. When you credit this account, you're automatically debiting bad debts expense. No exceptions to that. You credit the allowance account, and then you write off by crediting the accounts receivable, okay? The only exception, which I've never mentioned, would be a recovery. In other words, if we wrote somebody off and then they paid us, we could just reverse that entry. When you see a debit here, that's the write-off. So any debit to the allowance is a credit to accounts receivable. And allow me to go into something else here that I had prepared. Little thing here. I mean, it's just the same thing. I'm just making the point here. Under allowance for doubtful accounts, this side here is always a credit to accounts receivable. This side is always a debit to the bad debts expense. And let me just move this out of my way here. Here's your little formula here on the net sales. I'm pretty sure you're okay with that. You never debit sales. You never debit sales. You never debit sales. It's an easy mistake to make, though. You never debit sales. If you did debit sales instead of these guys, you'd still come up with the right net sales, but the company would have no clear trail on what was causing the difference. They want to know how many people took a discount, how many people returned stuff. And then I put this together briefly on bad debt expense. Let's see here, let me back up here. Sales method, we just went over this. Sales were this, you multiply it, whammo. How easy is that, huh? You got that, Samantha? Good on that one, okay. Let's look at the other method real quick. Here, we came up with a number of 6,000. We multiplied all the columns. That 6,000 is not the bad debt expense. It is the ending balance. So how did we get the bad debt expense of 2,000? We had to say 24,000 was the beginning, minus that gave us a balance, credit balance of 4 plus 2. Okay. And then the third section here, and I'm going to, instead of going back to the PowerPoints, I'm going to take us through this. The bank rec. Let's be comfortable with the bank reconciliation, huh? Bank reconciliation. The law firm of Dewey, Cheatham, and Howe, and you can figure that joke out later, okay? We are going to start with our general ledger amount and what the bank statement says, and there will always be differences due to timing. So let's do the bank statement side because that's the easiest. This is the easy side. One reason it's easy, you never have to do a journal entry here. We're telling the bank things the bank doesn't know. Well, we had $9,600 for the bank, but they didn't know about a $22,000 check, a deposit in transit that was in the mail. That's a customer check we received on the last day of the month. We entered it, and we didn't take it to the bank for another few days in transit. Outstanding checks, those are checks that we wrote. Those are checks we wrote that have not cleared the bank yet. So it's very, very basic. Balance, beginning balance, plus the deposits in transit, minus, gives us an adjusted bank balance. Now it's time to do our side, which takes a little more thinking, but all we're going to be doing is we're going to start with this amount, our balance for the checkbook, and then we're going to look at the bank statement. We're going to look at it, and we're going to notice things. Oh, look at this. One of the people we loaned money to finally repaid us. He direct deposited it to the bank. That's a good thing. It increases cash. Our checking account may be an interest earning account, so that's good. Well, we made an error, but at least it was an error where we get some cash back. Then the ones that would reduce it. An NSF bounced check. Check bounced. We didn't bounce this check. One of our customers did. So what we have to do is take that money out of our bank account because we don't have it anymore. But we didn't know it till the bank statement came. And the bank fees are on the bank statement, your interest expense. We add them up and we reconcile. This little template here, have this in your notes or whatever, have that in mind. It'll answer a lot of questions. Again, they'll give you a multiple choice question, perhaps along the lines of the beginning bank balance was this, and the ending was this, and the outstanding checks was this, and you'd have to figure that fourth number. I don't particularly like those questions, but they're coming out of the bank. And here, on this side here, everybody, you do have to write a journal entry. Anytime we're changing our checkbook, we have to enter it. So we have the collections on behalf and the interest income. Debit cash, debit cash, debit cash. Credit notes receivable, credit income here. And here's the bounced, customer payment. That was just a mistake we made. And then on the minus side, the customer's check bounced. So we have to reverse the journal entry. We credited accounts receivable and debited cash. Now we have to put him back up and go after the money again. Bank fees, expense. Every journal entry regarding a bank reconciliation will involve cash, either as a debit or a credit. I am now going to work my way through this here. Okay, we're back in the slideshow. Do you see that? Uh-oh. Come here, slideshow. Where'd you go? Okay. All right, hold on here. So I think we've gone through this pretty much the entire chapter. Okay, I'm just looking to see if there's anything else that I think I want to emphasize. Writing off the percentage of sales method, the aging, and that's pretty much the end of this thing until we get to the bank reconciliation. Okay. Here's an example of the contra account. Contra account, sales discount. This person was entitled to that $20 discount. So we got a check in the mail, not for $1,000, for $980. We are going to forgive their $1,000 debt, and that debit goes to that contra account. Same thing with sales returns and allowances. Customer returned some boots that cost us $300. The sale amount was $500. So you get a 4-line entry. Again, you never debit sales, you debit the returns and allowance contra account. You credit receivables because this customer no longer owes us the money, but he did return the inventory. So we get to debit that and credit the cost of goods sold, which we had originally debited. Cash equivalents. We know what cash is, huh? Money, you know, change, coins, bills, checks, certificates of deposit. You see it, money orders, drafts. I'm not sure what they're going to do with internal control of cash. Read that, just read that section over. You want to lock things up. The bank reconciliation is probably your most important control, as well as not having one person do all of this. You've already heard my speech a couple times on how you get in trouble with that. But the person who prepares the bank reconciliation needs to be different maybe from the person who approves the payments, who should be different from the guy who signs it, he or she. Basic internal control. And here's a very simple look at that template that I just showed you in spreadsheet form. Notice the balance per the bank. Direct deposits minus outstanding checks equals the ending balance. My tests, I never put any bank errors on, and I don't think Cornelia will either. I'm not saying it won't be there, but if it's a bank error, then yeah, you have another one to put there, okay? And everything on the book side requires a journal entry. Do you want me to go through this bank reconciliation? You feel pretty comfortable with the bank stuff? I mean, here they're giving you some information here, huh? They're giving you the beginning balances. That gets us started. We get started with the beginning balance for the checkbook and the bank. And then they're saying, here are the outstanding checks. Here is a deposit in transit. And then our bank made an error, the 486. Like I say, I don't put that on there. But see, let's take a look. You see how easy the bank side is? Balance per the bank statement, plus that one deposit in transit, minus that outstanding check, and this bank error. What happened here was they gave us $486 that didn't belong to us. Banks don't often do that. Companies don't make errors. And then down here, they're saying we had $30 in interest. We had a $28 goof on a check. So see what we have here. Deductions, we had a $28 goof. And then the 225, what was the 225? That was, oh, there it is, the NSF check, okay? Journal entries. Oh, I don't know if metrics are gonna be on the test. You should know this though. This is gonna be part of your first FSA anyway. Net sales divided by the average receivables, huh? Average receivables. Receivables at the beginning of the year plus the end of the year divided out by 2. Your turnover here is 7.6 divided into a year, which is 365. 48 days it takes this company to collect money from customers, okay? Anybody want to talk about something in this chapter? Any questions or anything? If not, I will go to chapter 7, okay? Chapter 7. Chapter 7. Do you see chapter 7 up there now? Not yet, right? Chapter 7, hold on. Where did chapter 7 go? Oh, here it is, okay. Okay, chapter 7. Now here we go. Now we're going to get into the world of LIFO, FIFO, lower of cost or market. Chapter 6 was the beginning of the much longer, detailed, multi-step income statement. Starts with gross sales, less your contra revenues to get net sales. At that point, net sales is 100%. 100% is what net sales represents. Every number below that is a component of that 100%, and that's what you're doing in your first FSA, the component percentages. Thought I would just throw that out there, okay? We should know when you buy inventory, if there's some freight on it, that would become part of the inventory item itself. If there were special costs involved, yeah, I don't think you have to worry about that. 4 methods of costing the inventory. And I'll go back to the spreadsheet to review this one more time. This is an important note. The total dollar of goods available for sale. That's your beginning inventory plus all of your purchases. That gives you available for sale. That's the most you can sell. If you had 100 books in the store at the beginning of the month, you brought in 900 more, that's 1,000 books available for sale. That's my long-winded way of saying that the cost of goods available for sale is the same for all the methods. That's your history. Specific identification. This one here should be easy because they are telling you which specific item was sold. In other words, they'll say 8 cars were sold from the beginning inventory. 10 cars were sold from the second shipment we received, okay? Cost flow assumptions. We do know, right, that except for this method, the cost flows have nothing to do with the actual physical movement of the goods. I think we know that, but it's always good to remind you. Average cost method, pretty easy. You take the available for sale divided by the units and then multiply out. I'm going to go into a little more detail. This thing doesn't. No, that's not me, that guy. I don't care what they say. First in, first out, okay? They repeat that, huh? Okay. Before we go into the calculation, this is quite important. Companies can choose what they want to do, right? First in, first out. First in, first out. We assume we sold the oldest stuff first. So under first in, first out, you're going to start pulling from your beginning inventory. Last in, first out, you are going to pretend that you're selling the most recent item you received, even though it has nothing to do with the physical flow. Mesa Produce, they can use LIFO, and theoretically, that means they never sold the first batch of bananas they put in there 50 years ago. We know that's not the case. Weighted average does just that. It just smooths them out a little bit. Here are some reasons why companies might choose one or the other, because it's going to give you different net incomes. Net incomes. You might choose FIFO because FIFO will give you a higher net income because of a lower cost of goods sold. And you'll see that in a moment when we go through a couple examples here. So a company might be fairly new on the stock market. Tesla right now is fighting like crazy to get listed on the stock exchange. So maybe Elon Musk.
They might after this week's call earnings.
What's that?
They might after this week's earnings and stuff, because they actually did better in their earnings.
They haven't even had any earnings up until this point, right? They've never made a profit.
Yeah, so I think they did actually more better than they were expected. I think they were like predicting negative 0.15 like per share, but they actually reported 0.17.
They made a little money. That stock has gone crazy, and I really don't know why. Nobody really
Like
knows.
the new Bitcoin.
It's quadrupled over the last couple of years. It's amazing. Yeah, Tesla might be the type of company to work with FIFO so that they can make a big splash. But other companies might go with LIFO because that will lower your net income, thus save 30% tax on that money, huh? We don't worry about this. Lower of cost or market. Cost of market. Everything in our inventory on our general ledger is at the cost we paid for it, right? We know that we bought something for $100. It's $100 until we get rid of it. But if the price goes down, we have to recognize that loss immediately. It's part of the conservative accounting principle. The conservative principle, you recognize losses and expenses as soon as you identify them, but you can never recognize a gain until you sell this stuff. Take us through this simple example here, I think. This company has this item, Pentium chips. They bought them for $250, right? And over the last couple of years, they were selling them maybe for $400. Then the price went down to $300. And now the salespeople are coming back and they're saying to the people, to the bosses, look, we bought 1,000 of these we didn't really need. We're never going to be able to sell these for $250. Maybe we can get 200. Well, that's a $50 loss. The cost is higher. We want to go with the lower of cost or market. So we have to take that 1,000 and multiply it by 200. That's our new balance there. Here is the opposite. We have these disk drives. They're still popular. They're still selling. We paid 100. We're selling them for 110. Cost is lower. We don't have to do anything. Note the journal entry. It's really $250 cost minus the replacement cost. That's 50 times 1,000. It hits cost of goods sold and reduces inventory. Okay, and we do not go into the liquidations here. Now, what I would like to do And again, jump in with questions. I mean, I'm babbling along here. Let's see. Here we go. First day of the baseball season, huh? Woo. I guess nobody cares, huh?
No, I care.
Who said that?
Me, David.
Oh, Dave. Oh, that's right. You're a sports fan all over, right?
Oh yeah.
A crummy 60-day season, though. Come on, this is so stupid.
That makes it more interesting.
Way more competitive.
Yeah.
Yeah, but
Anything
why
can
not?
happen.
Why not have 6 seasons during the year? We have a pennant winner every month if you want. Ah, you young people. Can you hear me now?
Yeah.
Oh, thank God. Okay. I just have to move this thing. I keep having to move this bar here that you don't see, and it covers up the ribbon. All right, here we go. Whammo. LIFO, FIFO, and all that stuff, okay? FIFO, first in, first out. That was first in. That was next in, right? We bought something on the 10th, the 19th, the 22nd, etc. We add up these units, multiply them out, and our cost of goods available for sale is this amount, $12,200 or 2,500 units. That's the most we could possibly sell. So at the end of the month, we either sold that 2,500 or we still have it, So let's see here. I'm telling you that we sold 1,500. 1,500. We're using FIFO. Where did we get that 1,500? We started here. We got 500 at 320. 500 times 4. And we don't need 800. We only need 500 from there. We multiply these 3 guys out. There is your cost of goods sold, okay? If I asked you to compute the inventory, well, you know you have 300 left here. You know you have 300 left there, and you haven't touched these 2 layers yet. You multiply them out, and you get a number, which happened, just a coincidence, it turned out to be 6,100 again. The better way to do it, though, is once you do one, you don't have to do the other, because cost of goods available for sale minus cost of goods sold equals the ending inventory. Cost of goods sold minus the ending inventory equals cost of goods sold. And the reason I point that out, you might get a problem where they're just messing with your mind. They might say we had 25,000 units here, and then we bought another 4,000, we bought 85,000, we bought 12,000. And then they tell you that they sold all of them except 100. Just do the inventory calculation for the 100. Don't kill yourself on the 150,000 number. Work with the smaller number. FIFO, we're good with FIFO? Okay. LIFO. This is the one that gives us lower net income. Let me qualify that. I am only talking about with rising prices. Any economy to thrive and grow has to be in a paradigm of rising prices. If they rise too quickly, that's called inflation, and that causes a lot of problems. But every question that I ever give out in this chapter is on rising prices. Like you see here, went from 320 to 4 to 5. Under rising prices, normal inflation, LIFO gives you a higher cost of goods sold. Look at that. The cost of goods sold was 6,100 under FIFO. Why is this so much higher? The answer is under LIFO, we are starting with the most recent one. Did I botch this up? Let me see here. Cost of goods sold. No, I did that right. Yeah, we're starting with the old stuff first. So we got the beginning inventory here. We got that amount. We multiply them out, and there's your $8,600. The difference would be the 36. The reason the cost of goods sold is higher is because we are selling the more expensive stuff first, okay? Those are the two where you have to think a little bit. I mean, you have to think about them all. I don't mean to come across that dismissive. I remember when I was trying to learn this stuff, it wasn't that easy. Average costing. This is an easy one. You are going to average this horizontal line, right? 12,200 divided by 2,500 gives you $4.88 each. And then you just multiply it by the amount you sold and the amount in the inventory, and you're done. Easy method, huh? Easy. Don't make this mistake. Instead of dividing, some students do this. Oh, I'm going to average these 5 numbers. And when you do that, I don't know if you can read it on the bottom, I get an average if I do that of 5.04. No good. No good. The only way this works is if the units were all the same. That's an average. This is called a weighted average, okay? Specific ID. Specific. Here, they're telling you which ones were sold. So it's just a matter of reading the problem. And I don't think they're going to make the wording too hard on the test. So specific ID. Which of these 2,500 did we sell? Well, I'm telling you, we sold 500 from the beginning inventory. I'm telling you, we sold 500 from the 10th. And I'm telling you, we sold 500 out of here. You multiply it across, and again, we're left with that stupid 6,100 number. Just another coincidence, okay? Where this can be a pain in the neck is not with the understanding of the numbers, it's with the way they word the problem. If you look in your book, some of those problems say something like 2/3 of the first sale came from 1/5 of the second purchase. And that kind of language can just confuse the heck out of you, okay? So that's a quick tour of the inventory methods, okay? I am now going to go, okay, let me get rid of this thing here. Let me go. Lower of cost or market. I think we're okay on this, huh? Man's shirt cost $25.60. Market price 22. What's lower? 300 times 22. Cost on this item 48. Market 80. We don't have to do anything. We keep the 48. Okay, I'm trusting that you're good on that. Okay. Here's an area where I at least have not talked about too much, I don't think, and I have a feeling that you will get a couple questions like this. This is part of the chapter 7 where they talk about what happens if you make a counting error at the end of the month. You counted the inventory and you did so incorrectly. So here's what happened. Note the belatedly discovered counting error. They counted $80,000 worth of inventory, which was wrong. And we didn't learn about it until it was too late. The month ended. We handed out all the financial statements to the world, and now we have egg on our face. Here's the point we want to make. That number should have been 30,000, okay? Now, I'd like you to watch what happens when I drop the 30,000 in there. When I hit enter, look at the cost of goods sold numbers on the bottom for 18 and 19. It was 130 and 10. That's what they should have been. That's what they should have been. Because we overstated the ending inventory. So that makes this year wrong by $50,000. And because we're starting the next year or the next month with the same bad, lousy inventory, the second year is wrong as well. So take another peek here. Here, we reported to the world that we made $130,000, okay? And here we said, well, we had a little bit of a profit. The reality is we had a tremendous year here, or month, and here we lost money. And it will not correct itself until the third year, as long as you count the second year end correctly. Multiple choice type questions on this type of stuff. If you understate the inventory, you understate the profit. If you understate the inventory, you understate the profit. Here, they overstated it by $50,000 and reported cost of goods sold of $130 when they should have reported cost of goods sold of $180. Here, they showed a profit of 10 when they really were supposed to show a loss of 40. I can copy this thing over to you guys if you like, if you think it might help you. But that is usually worth a couple of points on the test, just knowing that. If you are understating the profit in 1 month, you automatically botch up the next month in the opposite direction. And I'm going to digress to one of my experiences on the workforce. Where I worked at Thomas & Betts, we had a lot of companies and divisions around the world. And some of them did a lot of intercompany accounting. And that's something you would learn about in 240 if you ever take it. And you had to be very careful that you had the right accounts payable and the sister company had the right receivable. If you made a mistake, you not only botched up 2 months back to back, but you botched up 2 months for 2 different companies within Thomas & Betts. And this is not a lie. It got so out of hand at corporate headquarters. Thank God I worked 3,000 miles away from there, and I never worked at corporate headquarters. They actually flew everybody in from around the world just to yell at us for 1 day and, you know, try to resolve this. So you make a counting error 1 month, it botches up the next month, the opposite direction. And there's one other thing here. I'm just going to go over this fairly quick. The reason I'm going over this is because it was the first problem in your book, B71 or E71, and this deals with FOB. FOB, right? Free on board. It's a very, very, very important concept. Free on board. I call it freight on board, which I think is okay. Free on board. It is simply the point in time when title to the product passes from the seller to the buyer. And that is super important to understand. What happens at the point of at the FOB point, the shipper has no more responsibility for it. If it's shipped FOB shipping point, and I load a big truck out here and I fill it up, and as soon as that truck leaves here, I no longer am responsible for it. That truck could pull into the 7-Eleven down the street and the truck blows up and all the goods are destroyed. The buyer owns it and he's responsible. If it's FOB destination, I, the shipper, am responsible for everything until it gets to the other guy. Now, why would a company choose shipping point as opposed to destination? One reason is where I worked, we had cash flow problems. And at the end of the month, I might not have enough money to pay the payroll, which is not a good thing. But we had a deal with a bank where they would loan me 75% or whatever our inventory balance was. So I would call the guy in Oklahoma and tell him to load up a resin car with a $200,000 worth of stuff, FOB shipping point, and it would be mine to borrow. I'm just going to take us through these different scenarios here. I don't know how important this will be on the test, but I just like to get you prepared for some multiple choice. Goods, we sent $900 out to a potential customer. We invented a machine and we're trying to sell it, and we gave it to a possible customer, and we told the guy, try it out, see what you like, if you like it. If you don't like it, give it back to us, no problem. That needs to be counted in our inventory because we own it, not the guy who's just testing it. Goods in transit from somebody, we're the buyer now, right? If they were shipped FOB shipping point, we need to count that 900. Here, we are shipping FOB shipping point to a customer. As soon as we shipped it, it's not ours anymore, so we would not count that 1,700. Sometimes the customer, I mean, this happens in the retail world a lot, right? I buy, I do a lot of reading. I call up, what's his name, Chaucer's, and I ask if they have a particular book, and I give them my credit card number, and I say, I'll pick it up in 2 days. They don't count that in their inventory at that point because it's not their book. So anything that has gone out to a customer is not part of our world. That's when we're holding it for a customer. And then we just got 2 more, I think. Here we're buying something. It was shipped FOB shipping point. We're the ones buying. Shipping point means that we do have to pick up that $35.50. Goods sold and in transit. This would be, I don't know what I'm trying to accomplish with the goods sold in transit FOB. I guess this is FOB destination. Sold. So this one we would count. That's destination is what I'm trying to say there. And then understand what consigned goods are. Consigned goods. My favorite example, you'll hear it again for maybe the 5th time, is the perfume counters at department stores. You walk into Macy's when it was here, one of the first things you notice is the smell of perfume in the air, and you see those ladies schlepping jugs of perfume. That perfume was consigned to them by Chanel. Chanel says, I'll send you 5,700 bottles of perfume, and you don't have to pay me. Just try to sell them. So they sit there, and when the store sells one, they tell us they sold it, and then we bill the store, they pay us, and their customer pays them. The point is, anything on consignment belongs to the person who put it out on consignment. And the purpose of this problem was to say, this is what they physically counted. Here's how much they should have counted. Turns out to be 91,750. Okay. How about we go to another chapter? You ready for chapter 8, guys? Chapter 8. Chapter 8. New share, chapter 8. Doo-doo-doo. We all see chapter 8, right? Nod your head. Okay, I see a nodding head. That tells me we got something going here, okay? This is all about fixed assets, huh? Fixed assets. These are big ticket items like cars and buildings and trucks and stuff, huh? We're going to depreciate these tangible items, and we're going to have intangible items like patents and natural resources, huh? And again, we know the word tangible, you can touch it, huh? Intangible, it's there. Hey, Dave, it's like momentum in football, right? You know, you intercept. Anyway, I should digress from the sports stuff. Okay. Tangible, intangible. I want to go back up to that. This is a little note I'm going to mention. Land is never depreciated. You don't depreciate land. That's the rule. And I think the rule is because land typically does not lose value. You depreciate tangible items. You amortize intangible items, and you deplete natural resources. So let's take a look here. Here's a look at Southwest Airlines balance sheet. Here is the original cost of everything. That's the original cost of everything that they bought. This is how much they've so far depreciated over the years. That's the accumulated depreciation balance. This is their net fixed assets, okay? Understand, and I know you get a couple easy questions. I keep saying easy. Forgive me for using those words. You'll get a couple questions on acquisition costs, huh? You should know that you buy a plane, like in this example here, the plane cost $75 million. We're going to pay $75 million to Boeing, but we might have to paint it with our logo. We're United Airlines. The cost of that paint job is part of the cost of the fixed asset. If there's a sales tax, someone has to fly that plane from Seattle to our building in New Jersey. All of these things become part of the acquisition cost, okay? Part of the acquisition cost. I wish they gave us a little, another slide on that just to show some numbers, okay? Okay, we bought it, Southwest Airlines bought a plane from Boeing, I guess, for $75 million in cash. $75 million in cash. I'm deliberately skipping because this thing went a little bit out of sequence. That's not so hard. Flight equipment, $75 million. Maybe Boeing charged them $70 million and the paint guy charged them $2 million and the guy who put the fancy special seats in was another $3 million. You debit that fixed asset, you credit cash. Or you can make a little down payment and finance it with a note. Finance it with a note. And here is our journal entry here. We debit the airplane flight equipment for the same $75 million, but we only had to put up $1 million in cash, and the rest is borrowed from a bank probably, or an investment house, $74 million. Acquisition cost. Record at the current market. Sometimes you don't have to give them money. You give them some. You give them one of your assets, or offer a stake in your own company, which is what they did here. Southwest says to Boeing, "Look, I'll give you 1/3 of it in cash, but will you be willing to take the rest in stock? I'll give you 1 million shares." Boeing says, "Yeah, I like Southwest stock. I'm going to do that." So let's take a look at the journal entry. Again, we're buying the famous $75 million plane, right? The cash was 25. The par value of the stock was $1. Please get in the habit of understanding that the only thing you're going to do with the par value is multiply it by the shares. And that's going to become the line on your balance sheet called common stock. It's an equity account, as is the difference between that 50 million and the 1 million. That's called paid in capital. That too is an equity account. So they're just showing you different ways you can do it. Sometimes you can build the item yourself. Again, we did something like this where I worked when we moved into our new factory. Our guys did a lot of the labor, and we were capitalizing whatever was appropriate. Here's some low-hanging fruit for the test. The difference between an ordinary repair and an improvement. An ordinary repair is an expense, and you expense it right away. An ordinary repair simply keeps the thing working the way it's supposed to. It doesn't improve it, doesn't extend the life. It's something you got to do every once in a while, and small dollars. You bought a $250,000 machine, And once a month, you have to put $20 worth of oil in it, change the oil. That's an expense. That would be oil expense or repairs expense or something, huh? But don't confuse a repair, which is an expense, with an improvement, which is capitalized. The word capitalized means you're putting it on the balance sheet. Capitalized. You've got that same $250,000 machine, and now you spend big money to rebuild the engine, and you really crank up the capacity. You've increased the efficiency. Now it's going to run more efficient. It might last longer. That is a classic improvement. That would be a debit to the machinery, to the fixed asset. Capitalized goes on the balance sheet. That's the improvement. This is the repair expense, okay? And WorldCom was one of the real frauds. This company decided that they didn't have any expenses, is basically what they did. And they told their accounting people, no matter what it is, you put it on the balance sheet, call it building or something. And as a result, they inflated their profit by that amount. Those people are in jail. Depreciation. We understand it's an allocation using systematic and rational thinking. That's an accounting term. And we're going to take that acquisition cost, the 75 million, whatever it was, and we're going to say to ourselves, that machine has a certain life in years, and we're going to, depending on the method, recognize an expense on the wear and tear on that machine. That's called depreciation expense. Process of allocation has nothing to do with the market value, right? Nothing to do with the market value, and that's important to understand. And there's your journal entry. It's always a debit to depreciation expense. Let me close the noise here. I'm back. Okay. Where was I? Journal entry. It's always a debit to depreciation expense. It's always a credit to accumulated depreciation, okay? In order to depreciate the asset, we have to know what it cost, what the life expectancy is, and the residual value, which is the salvage value. How much we think somebody will give us for this thing after we've worn it out. Straight line, units of production, double declining balance, huh? Straight line is the easy one. You divide the depreciable base by, in this case, 3 years, okay? Hold on a second. Sometimes I can chase them away by playing the guitar on the porch out there, okay? The key thing here with straight line, guys, you do not depreciate the residual value. So you have an item for which you paid $62,500, you deduct the $25,000, therefore it's going to be $60,000 divided by 3, okay? Here they're just talking about different planes. Straight line, showing it to us again, I guess. Look at this little grid here. We bought a machine for $62,500. That's the 0 hour. That's where we bought it. And we're depreciating it $20,000 a year. $20,000 debit depreciation expense, credit accumulated depreciation, and that's the balance after 1 year. So let's take a look at this. Here is the depreciable. Here is what we paid for this thing. The residual value was 2,500, so we can never go below that. Now, the reason I like you to take a look at this for a second, I know you'll probably get a testers along the lines of, we bought this machine for 62.5, the residual was 25. What is the balance in accumulated depreciation after the second year? If you organize it this way, you can pop that answer right up there. Okay? This is a nice grid to have. Straight line is an easy method used by most companies, huh? Here, we're going to talk about units of production. This is the same thing as depletion when we get there. Again, you are going to subtract the residual, so we know we're working with the 60,000, right? We're working with $60,000. Only this time, we're not interested in years, we're interested in miles. We're interested in miles. We bought the 62,500 machine, and we want to get 100,000 miles out of it. So guess what? Our calculation is 60 cents a mile, right? 60 cents a mile. Now, when we come here, you see the miles down here, everybody? You're not going to have to compute that. They're going to give it to you. They're going to give you the miles. I can't imagine they're going to try to mess with your minds on that. So it's 60 cents a mile. 3 times 6 is 18. There's our journal entry. There's our book value after 1 year. There's the calculation, 60 cents. And there's the finished product. Again, you might get this information here. They might give you what you see in white, and the question will be, what was the depreciation expense for year 3? What was the balance and what was the net book value at the end of 2 years? 14.5. I don't think the depreciation's too tough. As long as you understand, we're going to be reducing that net book value. You never credit the original cost of the asset. You never do that. Never, never, never. Okay, accelerated depreciation. Here, a company can choose this one if they want to front load a lot of the expense. And they may choose to do that for different reasons, okay? You see where it says declining balance? Put double in front of that. Double declining balance. Double declining balance. I'm emphasizing the word double because that's the hint on how to figure out the percentage. It's double whatever straight line would have been, okay? Whatever straight line. And in this example, we were doing 1/3 per year, right? You divided it by 3 years, 1/3. 1/3 times 2, guess what is 2/3? 2/3. So here's what we're going to do. We're now going to go back to our famous grid, and we're going to start with the same 62.5, but this time we are not subtracting the residual, okay? So here we go. Take a look at it. We're starting with the 62.5 times 2/3, not 1/3 like straight line, it's 2/3. So there's your expense, there's your net book value after the first year. And here we go. 20,833 was the new value times 2/3 equals that. Accumulated depreciation is growing. And then please take a note here. We had almost 6,944 times 2/3 is 4,629. But guess what? You can never go below the residual, which is 2,500. So we have to adjust this number. We have to reduce this number by $185. Knock it down there, okay? Depreciation expense. Depreciation expense. there should not be anything on taxes. You notice we never talk about taxes in this class? The reason is, if you're interested in that, you'll get we got a whole beautiful course on that taught by Barbara Aue, A-U-E. It's a really an amazingly well-developed tax course. And a couple of friends of mine were telling me they work for an accounting firm. When they hire graduates from UCSB, the first thing they make them do is come down to our school and take that tax course. So it must be pretty good, huh? I'm not going to get too involved with impairments. Impairment simply means we have to recognize that the asset is no longer worth what it was. The best way I can say it, you have a machine that is supposed to, in the future, give you $1 million worth of business, and now the product that you were hoping to sell is going out of style. You have to recognize a loss on that machine. So I'll ask you to kind of look at that on your own. If you want to text me or email me, or I'll be glad to, write back to you on that. Let's not have any problem with the disposal or sale of a fixed asset. The asset can be sold at any time, right? It might only be partially depreciated. We can still sell it. Here's what I'm going to tell you. You ready for the secret on this? The net book value at the time of sale. Cash, if cash is more than the net book value, guess what? We made money. If it's below it, we didn't. If it's the same, we're broke even. Let me show you a simpler way to do it. Southwest Airlines sold flight equipment for that amount. So we know we're going to debit cash, right? And the equipment originally cost $20 million. So we know we're going to credit that. And we know they had been depreciating it for 20 years. So we know we have to take the accumulated depreciation off. So that's for 17 years, I guess, right? The amount of depreciation to be recorded at the end of this period here would be the 1,000. We were depreciating this thing for $1 million a year, right? Now at the end of the 17th year, we're getting rid of it. The equipment's book value at the end of the 17th year would be, if there's a God in heaven, it'd be $3 million, right? Net book value, 20 million minus the accumulated depreciation over 17 years. So we sold it for 5, right? Net book value is 3, we sold it for 5. Again, I'm calling on my God above for a $2 million gain. Okay, that's a bit long-winded. Here is the Bob secret, okay? Look at this journal entry. These 4 items are always the same. There's no exception. You're going to debit cash. You're going to debit the accumulated depreciation, which is the contra asset, to this case, the flight equipment. So now you've gotten rid of the accumulated depreciation. You're going to get rid of the original 20 million because you know you never credit that unless you sell it. And then you're just going to add these 2 columns up and figure out if it's a gain or loss. This is higher, so we need 2. It's a gain. I'm thinking if you can just remember that those 4 lines. Or, I guess this is a lot easier if you understand it. Net book value compared to the cash. Cash minus net book value is your gain or loss. Okay? Gain or loss. No exceptions to this entry. Okay. An oil well. Woo. An oil well. A company invests money and they want to see if they can strike oil. And they spend millions and millions of dollars on this. Now, they are going to deplete it. If you call it depreciation expense, you'd be wrong. It's called depletion expense. Depletion means that you're using it up, like I'm depleting the soda here. They're depleting that oil well. So what they're going to do is they're going to take whatever it cost to develop that oil well, and they're going to come up with another residual value, like we did with depreciation. And then they're going to divide it by the units. This is an estimate, and this is an estimate, but that's what they're going to use. Okay? So depletion cost, wow, that's a pain in the neck there. Hold on, am I missing something here? I have a better look at that on one of my little spreadsheets I'll go to. But essentially, if this thing cost them $1 million to build, and they expect to get 10 million barrels of oil, that's 10 cents a barrel every time they bring one up. Acquisition. Okay. Intangibles. Intangibles. Couple rules. Intangibles. Intangibles have a definite life. They have to have a definite life, and they're always straight line. Amortization similar to depreciation, depletion. If we don't know what the life is, we can't do anything with it. And we have to test it once in a while to make sure that it's still worthwhile. Okay? In other words, 10 years ago, somebody spent billions of dollars for a patent to make BlackBerry cell phones. And now that company's in big trouble, so the patent's not worth what it was. Goodwill. We're going to talk about goodwill. Goodwill. You paid more than the fair market value of the company. Not the book value, but the fair market value. Goodwill. Okay. Goodwill. I'm sure there'll be something on goodwill, okay? ARPEC paid $2 million to purchase all of UTEC Company's assets, and they assumed liabilities of $400,000. And then they looked at the assets. They looked at the assets and they decided those assets today are worth $1.8 million. UTEC might have only had these assets valued at $1 million because that's what they paid for them. So the goodwill is a comparison between the fair market value of the company minus the liabilities. So let's see. They paid $2 million for a company valued at $1.4 million. And these slides, of course, are available on Canvas, and this is one you might want to look at. Fair market value. Notice they didn't tell us what the assets were from the old company. They didn't tell us what the capital was from the old company because we don't need it. All we know is we're going to give these guys $2 million. The only number that's firm is the liabilities. That's how much they owe. We have to take that over. Fair market value of the assets minus that debt. We purchased a $1,400,000 company for $2 million. Goodwill. We paid more. We paid a lot more, huh? The company, we ourselves are saying that it's only worth $1.4 million. We're paying almost 50% of that on top. And the reason is we think we can take this company and make a ton of money. We've been dying to buy this company. We've been dying to get our salesmen into their customers. We think we can really make a lot of money with this company. That's why we pay more. What are intangibles, trademarks, copyrights, intellectual property? I like this one here, copyright. Legal life is life of a creator plus 70 years, huh? So you write a book, then you die, and your son can hold the copyright till he's 70 years old, okay? And of course, you can always sell these things. Patents is patent is the only amortizable item where we're going to have to know it's 20 years, okay? 20 years. It's an exclusive right to sell or manufacture an invention. And it's developed over a long period of time, probably. Right now, pharmaceutical companies are fighting to be the first to come up with a COVID-19 vaccine. And when they get that, they'll be able to patent it and go from there. And once they have that patent, they have two choices. They can either choose to keep the patent and produce the product themselves, or they'll sell the patent to another company who could actually make the stuff on mass market. During the development of a patent, every expense in research and development is just that, an expense. So these companies got a tax benefit by every dollar of research and development was considered an expense and thus lowered their net income and taxes. Now they've developed this patent. The company that develops the patent does not have the patent on their balance sheet. Isn't that interesting? The company who invented the cure for COVID-19, they have a patent, they own it, they can do what they want with it, but it's not on their financial records because they already spent the money for it with R&D. The company who purchases the patent is the party who amortizes, okay? You know, you invent a product and you have no ability to market it, you have no ability to mass produce it. You don't want that headache, you want to cash in now. You sell the patent for $1 billion and, you know, live comfortably. Patents. 20-year life. They're giving you some other examples here, franchisees, any kind of intellectual property. I can't even, that I'm going to skip. Now, here is a problem where more than a few of you contacted me over the last few days. I was a little bit amused because it is a little tricky thing. And this will be on the test, huh? What happens if we change the value of an asset? We had a useful life of estimated amount, we had a residual value, but something can happen to change the life, something can happen to change the residual. If these estimates change, the book value, less any residual value at the date of the change, is depreciated. Let me see if I can make that a little simpler sounding, okay? Southwest bought an aircraft for $60 million, and they're depreciating it straight line, $3 million a year. Then in year 5, and I'm going to assume that's at the end of year 4. In year 5, they realized that this plane is in great shape. So they decide that they're now changing the life to 25 years, and they're lowering the residual from 3 to 2.4. What we have to do is say to ourselves, we had originally purchased it for $60 million. We've depreciated so much from that. That's the remaining book value. And now to that, we're going to redo our calculation. And I think if you see it here, excuse me, I was right at the end of year 4. They purchased this thing for $60 million, right? And they were depreciating it at a rate of $2,850,000 a year. So after 4 years, they had rung up that much in accumulated depreciation, meaning the book value at the time of the change is now $48,600. But they changed the residual from 3 to 2.4. So we have to subtract that now. Now it's a 25-year machine. We've already chewed up 4 years of its life. We divide by 21 to get the new annual depreciation. Practice this a little bit. It's pretty logical when you look at it here. Let me just do one last thing. I know we've been here a while. We've been here a while. I'm being spammed. Hold on here. Let's go here. Come here, you. I'll just briefly go through here. I shouldn't use the names, but here's the problem where a couple people had this problem. The original cost was this amount. This is from your homework. They had that originally. That was the salvage. That's where they were, and then they came up with the net book value at a certain point in time, new residual, and off you go. But I digress. Okay, I'm glad I found this here. Very simple. I'm not going to read that whole paragraph. Melot. Hey, Dave, are you there? Dave cut himself. You there, Dave?
Yeah, I'm here. I'm listening. I was just laying down.
Who was Melot? You were lying down? Jesus. Who was Melot?
Who is who? A
Melot.
company? It's a company.
No, he was one of the greatest hitters in baseball history, but that's okay.
Oh.
Yeah.
No
Anyway,
clue who that is.
Here we go. Melot bought a machine for $250, and then he had to pay delivery to bring it in. He had to knock down a part of the wall to get it in. He had to buy an insurance policy to cover the, etc. And then he spent $7,000 on lubricating to get the machine going forward. Everything here except the lubricating is part of the acquisition cost. That's the only thing I'm trying to point out with this little slide here. So he paid $250 to the vendor. He paid $15,000 to the trucking company. He paid $35,000 to the construction crew. He brought in a painter. He debited that lathe for $304,000. Okay, I don't think that's too bad. The acquisition cost world. Okay. This is what we were talking about before. Expense or capitalize. Company spent $20,000, huh? It was done to increase the life, efficiency, and speed. It's not an expense. It goes right to the fixed asset. You debit the lathe and you credit accounts payable. Melot Company changes the oil monthly and cleans it weekly. And this is how much they spend. Both of these items are expenses, not a capitalized item. Capitalized means you put it on the... I don't think we need to go through another pile of depreciation schedules. So I'm going to go past this, and anybody wants to stop me, I'll be glad to work with you. Amortization. Let me point out something here. You debit amortization expense, huh? I bet you all figured that out, huh? But you credit the asset. There's no such thing, in other words, there's no such thing as accumulated depletion or accumulated amortization. Here is the key concept. We bought a patent from a drug manufacturer, and this patent was 5 years old. This drug manufacturer kept the patent. When we bought it, it only has 15 years left. Don't make the mistake of taking 60,000 divided by 20. No, that patent has a legal life of 20 years from the day it was approved. If we buy it after year 5, we only get the benefit for 15 years. There's your expense there. Depletion. Sunoco Oil developed an oil well. $2 million. The geologist says it's going to give us 10 million barrels. Right, huh? $2 million divided by 10, it's 20 cents a barrel. They had 80,000 barrels. I should have put the number here. Plus 80,000 times 0.2. That was 0.2. Come on, 0.2. Here we go. Now we got it. Okay. Not 222. Disposals. We went over the disposal. That's the 4-line journal entry. Impairment, improvement. Well, that's about it for today, guys. Hopefully it was helpful. Anybody have questions, comments, suggestions?
I have a question about the assignment that's due. Can you explain the instructions?
The FSA?
Yeah.
Yeah, I'll be glad to. Hold on here. Just give me a moment to dig that guy out of here. When is that due? Over the weekend?
It's due on Saturday.
Saturday. Okay, today's Thursday. Okay. Ah, it's empty. It's in a different file. Give me a moment. It's got to be here. If it's not, I can recreate it fairly fast. I know I have to work my way through this one first. Okay, here we go. Give me one moment. I'll show you. Okay, we're getting there. You share. Okay, what we're talking about real quick is it's called component percentages and time series analysis. And it's not as hard as it sounds. You're gonna have net sales. And let me just get this thing to a point where I can read it myself. Oh boy, Ariel the mermaid. Okay, here we go. Net sales. Your next line is going to be cost of goods sold. We subtract that out, and we're going to get gross profit. And then you're going to subtract out operating expenses. And this template, by the way, is in Canvas, okay, when you go into the assignment. Expenses.
Template is actually a PDF, so it looks like we have to actually build it.
Yes, Cornelia told me to make sure it was a PDF as opposed to a spreadsheet.
Okay.
And then she has her reasons. We have our reasons, right? Okay, so here's what we're talking about. We'll just make up some numbers here. 100,000. Well, yeah, just make up some crazy one. Okay. Okay, we subtract that, we get the gross profit. Let's say we had 52,147 in operating expenses. That minus that equals that, okay? You're going to pull this information from the 10K or the annual report for Kellogg's and General Mills, okay? You remember I mentioned before that net sales is always 100%? That's your 100% right there. That's 100%. Not 10,000%, it's 100%. Okay? 100%. Component percentage is simply this, everybody. Every one of these numbers is going to be divided into that. So this divided by that is that. Okay? This divided by net sales is that. You get the idea? Is that. Okay, I just did it the long way. Now we, Cornelia and I, we demand, I believe, 1 decimal here. So that's important. You get knocked off.
You guys want 1 decimal just on that one. What about
Yeah,
the dollar?
You're gonna
Or-
have to read the directions pretty
Yeah.
clearly.
Yeah, I
Yeah.
saw that right there. But my question is, do we round off the dollar amount to the closest cent, or do we just leave it as an estimate, or just, for example?
Oh, no, you round it off. Yeah.
No,
you
but I
don't
mean
have-
like the dollar amounts too.
The dollar amount, oh, no, you won't, no. You're not, I think I understand your question. No, you're not gonna worry about decimals here. Is that what you're asking?
So just like, for example, like if it's 898 with 94 cents, do I
Just
put
round it up.
99? Okay.
Yep, absolutely.
And is there a specific reliable financial statements you want us to be checking on? Like, for example, should we check it on like Yahoo Finance, or should we go to their actual page? Should we go to, where should we get that so that basically
I'll show you in just a few moments here.
Cool.
Good question. The answer is yes, you can go to those things, but I would suggest you go to these other sources first. You're gonna pretty much go to the annual report, the 10K, George.
Okay.
These are your component percentages. Component percent, okay? And this is gonna be, say, for year one. Okay? And you're gonna do the same thing for year two. Okay, so we'll put it right next to it here. This will be year two. And you'll have different numbers. And there you go. So you can, these numbers are foolish. I just made them up. So you can, you can look at this and you might compare the 2 years, and these numbers are not realistic. But if you were doing your analysis, you'd say, wow, sales fell quite a lot. Sales went down about 10,000, and wow, their cost of goods sold went from 16 to 40. What happened? You'll be able to find out what happened by looking at the annual report, which I'll show you. You'd be able to look at their operating expenses. They'll say, look, their cost of goods sold went through the roof, but they did a great job controlling operating expenses. That type of thing, okay? So that's the component percentage part. The next part is called the time series, okay? The time series. And what we're gonna do is we're gonna compare these 2 years, and we're gonna do it in dollars and a percentage. Always start with the current year minus the prior year to get the dollars. Wow, sales fell by 10 million. Woo, pretty bad, huh? So that's the dollar side of it. Now let's do the percent side. And you guys are taking math classes that I could not pass right now unless I really brushed up on my old algebra and stuff. So I'm just going to show you a very simple formula that I like to use. To get the change, let's call this what this is. This is the change in dollars, and this is the change in percentage. Your formula here should be, and let me see if I can put this thing in here correctly. Again, you start with the current year divided by the prior year, put it in brackets, minus 1. And there you go. And I think we want one more decimal here. So what happened here? You can go into your sources. Let's see. Sales really fell for some reason. They fell by 11.8%. And you try to figure out why. This could be Kellogg's. So you find out what happened to Kellogg's. You do the same thing for General Mills. And then you figure out what happened with General Mills. Then you can compare the two companies. Maybe General Mills had similar sales, but their cost of goods sold percentage was only 25%. Why is their percentage so much lower? And you read in, and you can read into the annual report and get some ideas. They might talk about they have a long-term contract with a sugar grower in, I don't know, where they grow sugar, in Jamaica or someplace, okay? And you just fill all these numbers in. This here, this is what your front page should look like, exactly like this. That's Kellogg's. Skip
Can
a
you
line.
do the percentage one more time? How did you get the negative 11.8?
Okay. Beginning year divided by that, by the prior year, -1. If you're doing Excel, you have to put them in brackets, but
Thank you.
okay. So this is what your page 1 should look like. And I think I told you, I own a pretty good chunk of one of these stocks. I don't think I told you which one. So when you get done, I'd be interested in hearing if I bought the right one or not, huh? Now, George, you were asking where you want to go for some of the information. I will show you.
Yes, sir. And then on top of that too, another question, because I'm trying to get all these assignments done before the weekend. I messaged
Good
you
for
about
you,
it.
George.
Yeah,
Go ahead.
yeah, it's 'cause I'm gonna be out of town. So do you want us to make at the bottom like the asset turnover thing, a box for each one, like for Kellogg's and General Mills, or just collect?
I'll show you. I'll show you
Oh.
in a moment here. Yeah,
And another question.
go for it.
Does it matter if I put the tables next to each other, like one next to each other, or do you want them also like one on top of the other?
The way I set it up here, I think is best. One on top of the other.
Okay, yeah, because like at first I kind of had like Kellogg's on one to your right, and then I had to your left, and then I had General Mills to my right, but you could still see them within the page.
Yeah, if it looks nice and neat, I'm sure that's going to be okay. So
Cool.
Google annual report, huh? Let's go to 2018. And the first thing you're going to see is what the stock is doing today. It's up 95 cents. Blah, 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 blah. Here you go, annual report, right? Now, this thing can be quite huge, huh? So,
We can't see it.
how come?
We can only see like the Excel file.
Well, aren't you fussy? Now you see it? I'm
Yeah.
sorry about that. My bad. Kellogg's. Hell, you don't remember there was a commercial when I was a kid. Kellogg sugar corn pops. Air tops. No, never heard that. In those days, sugar was considered a good thing, and their advertising was they were shot with sugar through and through. Okay, this is their annual report, and they worked in the 10K with it, okay? This tells you more than you could ever want to know about Kellogg's. And it starts with some jargon here, and just kind of fish your way down. And it shouldn't take too terribly long to start coming to some financial numbers. Here they're telling you about who the officers are, their backgrounds. People want to know these things, risk factors. So I'm just going to keep thumbing my way down. I think this goes to like page, I think it's going to be like on page 50 something. Where are we now? 15? Okay, let me just be a little more aggressive here to save time. 21, this thing is slow, huh? Here we go. Okay. Right here you go. You can work with this to get your numbers. There's your net sales. There's the gross profit. The difference between the net sales and the gross profit is your cost of goods sold. There's your operating profit. The difference between the gross profit and the operating profit are your operating expenses. So you can get it from here, but I'm thinking we'll find something better in just a short moment here when they put the statements together. Oh, come on. Where are we? I'm pretty sure it's like page 50 something. $41, $42, $43, $44. Almost. A lot to read, isn't it? Here we go. Now we're getting there. Here, look at the statement of income on page 54. Here are your net sales. Here is the cost of goods sold for 3 years, which you need, right? Net sales minus cost of goods sold equals gross profit. And here are your operating expenses. Selling expense, general and administrative expenses is a very definition of operating expenses. Okay? That's where you would get all the information for the page we just looked at, okay? When you get to the second part of the FSA, scroll down and grab the balance sheet, because when you do the AR turnover, you're going to have to know the average AR, and you're going to have to know the credit sales that you're going to get from the income statement, okay? Here's their equity statement. This is what we'll be looking at in future chapters. See, they've got common stock. They've got treasury stock. You'll be learning about that. They have some other things. Cash flows. You see this big complicated cash flow statement? This is a whole chapter coming up in about 2 weeks, okay? Now, what do you see here? Notes to the financial statements. Let's see what they say. Let's just see what let's pick something out. Accounts payable. What could they possibly say? Let's do accounts receivable, because I think that's more interesting, at least it is to me. Accounts receivable consists of trade receivables at invoice cost, net of allowance for doubtful accounts, huh? And they notice they give discounts, prompt payment discounts. They don't charge interest on receivables, which is normal. The allowance is an estimate of the credit losses in the current as determined from the, see, this is all very useful stuff. Balances are written off when management determines the receivables no good, and the company did not have any off-balance sheet credit exposure, and they just go into detail. So you can get a ton of information out of here, a ton. That's the financial information. I'm just going to back us up to the beginning. Scroll through some of the stuff at the beginning here, because I think it happens to be a little bit interesting. They tell you what the company's all about. They're telling you what their products are. Do you guys eat cornflakes? Do you ever get Pringles? You know all these products, right? So Eggo, I love Eggos. When my year-and-a-half-old grandniece came out a couple of years ago and I had a babysitter, you know how I shut her up? I threw a frozen Eggo in her mouth, and she sucked on it like an ice pop. There you go. And here, they're talking about snack brands they have. And here, they're talking about some possible risk, climate change. These are things they worry about, these companies. Anyway, there's a ton of stuff here. And going through here, and you don't have to read it word by word, but a lot of good stuff. Wow, look at their trademarks, huh? Look, here's the world of intangibles. Trademarks, Kellogg's, Old Brand, Apple Jacks, Frosted Krispies. Then they have some other stuff. Let's see what else they have. Would you believe these slogans are intangible assets? Other companies are not allowed to say that their product, they can't say about their product, they're great. You know, Tony the Tiger, right? Only Kellogg's can say they're great, or Lego My Eggo. Lots of good stuff, huh? Working capital, customers. Look who their biggest customer is, huh? Walmart. 19% of their sales go to Walmart. Backlog. This tells you how long it takes them to fill an order. Anyway, I think you get the idea. Is that enough to get you going, George? What do you think, Joanna? Is that helpful?
Yes, sir. Got it.
Yeah, it is helpful.
Okay. All right. What time is it? Wow, we've done this for almost 2 hours, huh? 2 hours. Hey, Joanna, who do you think will win the National League pennant this year, the baseball season? You got any ideas on that?
I know nothing about baseball.
You know nothing. Okay. I know I'm only teasing you. My
What
poor,
do you got?
what's that?
What do you think?
I think my beloved Cleveland Indians are going to have a good year. So I'm picking I'm picking the Indians. Who do you root for?
I'm a Dodgers fan myself.
Dodgers? No, I'm one of these people who hate the Dodgers since they left Brooklyn. My father was a big sports fan, and his parents were from the Ukraine. They spoke almost no English, and they hated American sports. And New Year's Day, they thought it was one game that went on for like 12 hours. They kept asking when the game would finally end, you know? Okay, good to see you all. Hopefully we helped you out. You know where to find me, okay? I'm going to be out of the office here for a couple hours. But we'll catch you later, okay, guys? Give me the friendly raccoon wave. Okay?
Thank you.
All right. Hey, Kate?
Yeah.
Did you get that little video I sent you?
Video? Oh, yes, I did. Thank you for
Now
that.
you understand what I'm talking about.
Yeah. Yeah.
Okay,
Is
bye-bye.
the recording of this video be available soon? I'm just wondering because it's a great reference for studying.
Let's hope I recorded it. I'm not sure.
It
Did I tell
is
you-
recorded.
I hope Cornelia doesn't listen to this last minute, but she got a little mad at me. She suggested that I don't hit the record button until I get a student. And I said, well, the reason I do that, Cornelia, is I might forget. I said, why don't you want me to do that? She says, well, I watched you sit by yourself for 5 minutes. You're making stupid noises. You're drinking. you're goofing around on the guitar. You were yelling at a neighbor. So hopefully I recorded this. We'll know in a moment, okay?
Great. So if it is recorded, is that something that we can reference soon?
Yeah,
or
it'll take an hour or two to get it racked up, but I'll get
And
it out.
then And then is it on your YouTube channel or is it going to
It'll be on both.
in
I'll put it on the YouTube channel. I'll put it, and Cornelia's the one who puts it on Canvas.
Great. Thank you so much. This was really helpful.
You're welcome. Good luck. Here we go. Bye-bye, everybody.
Bye-bye.
Bye.